Hi, this is Shubhankar Chakrabarty from American Academy of Financial Management. And today's query is, what is modern portfolio theory and what are its key principles? Can you explain the basic concept of MPT, such as portfolio diversification, risk return trade-off, and efficient trade? Chलिए, okay. So MPT is an investment framework which works on mathematical approach to construct portfolios that aim to maximize expected return for a given level of risk or minimize risk for a given level of expected return. So पहले बता दूं, MPT or modern portfolio theory is the theory designed by Harry Markowitz in the 1950s. So बहुत पुराने एक theory है, and but then it's very relevant even today, and I guess it is the mother of all the theories that we use in capital market in constructing our portfolio. So इस modern portfolio theory का मतलब ये है कि किसी भी एक पर्टिकुलर रिस्क पे सबसे ज्यादा रिटर्न कौन सा पोर्टफोलियो देगा. सो हाउ टू मैक्सिमाइज योर रिटर्न ऑन अ पर्टिकुलर लेवल ऑफ रिस्क. इतना रिस्क लेके कितना ज्यादा रिटर्न में ले सकता हूं, और एक पर्टिकुलर रिटर्न के लिए मुझे कितना रिस्क कम लेने से भी चलेगा. सो दैट इज बेसिकली द फ्रेमवर्क ऑफ एमपीटी. ठीक है. सो नाउ वी विल सी व्हाट आर द प्रिंसिपल्स. The first one is portfolio diversification. So if you have to mitigate the risk, if you have to bring down the risk for a certain level of return, how do you do that? So generally we say that we have to do asset allocation. But what exactly does that mean? It means diversification. Multiple asset classes across all sector, across all geographical region. अगर आप उस सारी चीज को एक particular portfolio में डाल देते हो, so then the idea is not all asset class will be going down or will be underperforming at the same time. So while some asset classes will make losses, some will make profits, and this way your portfolio will generate the maximum amount of return that it can generate for a particular risk that you take. And how do you measure that risk? You measure that risk by averaging out all the risk that you have in all the asset classes that you are putting in a portfolio. So this is how portfolio diversification is one principle of modern portfolio theory. So this is how you mitigate the risk, and you also maximize the return, okay, through this asset allocation, through this diversification into multiple asset classes across all sectors and geographical region. Okay. The second one is risk return trade-offs. How much of risk you need to take to get what kind of a return. So some investment portfolio will have a very high risk, but then that clearly means that they are looking for a very high return. Some portfolio will have a very low risk, and that will clearly mean that they will be looking for a very moderate return, right? Moderate to low return. So this trade-off is another principle of MPT, modern portfolio theory. Is depending upon your risk that you have taken in your portfolio. How much is the return that you're getting? What is the trade-off? Whether you want to take higher risk or you want to settle down with lower return. So that's the trade-off that you have to make, and that's the trade-off we all make as an investor, as an investment professional. How much of return we want? कुछ कभी-कभी हम लोग बोलते हैं कि रिटर्न को चेज मत करो, रिस्क बढ़ जाएगा. नेचुरल बात है. So people who are very conservative, they will say this: return को chase मत करो. Return को chase करने का मतलब क्या है? You are increasing your risk. You see, in equity market, we have when you look at the market, the first thing that you should look at is volatility index. लोग volatility index को बहुत track करते हैं, और इसलिए track करते हैं कि they want to see when the market is moving up, what is the volatility index? Whether the market is getting volatile because the prices are going up. Sometimes market prices go up, but volatility stays there. That clearly means that the market prices are pretty much in sync with the market. So nobody is looking at it as a risk. But sometimes they look at it as a risk. And that is when people start selling. And some conservatives, they will say that do not chase it. You might increase the risk in your portfolio. So that is the risk return trade-off. Okay. So depending upon your risk appetite, you should be allocating your assets and building your portfolio so that based on that particular risk, you can get maximum return. Efficient frontiers. Efficient frontier is that point where a set of portfolios will give maximum return at a given level of risk, and portfolios will, at a given level of expected return, will minimize the risk. So that is the point. The efficient frontier is the point where a portfolio will have optimum return for optimum level of risk. So that is what efficient frontier is. Okay. So it is basically the point, the line where everything is optimal. Okay. All right. And CMPF is basically an extension of modern portfolio theory. So actually CMPF is a model, capital asset pricing model. This helps you to estimate the return which you should be expecting from a particular asset class, depending upon the risk that that asset class has got compared to that of the market. So if and that is denoted by beta. So if, like we have discussed in our previous queries, that if beta is greater than 1, so your expected return should also be greater than what market return is. So that is what CMPM helps you to estimate, that for a given level of risk, what is the expected return. So it helps you, the CMPM formula helps you to identify that. Thank you.